Hey, all you beautiful people. I've got the one and only Emily Magill with me today. She's with Intercap Lending, and we're going to talk about some special kind of programs. And actually, they're not special, just a lot of programs maybe people aren't aware about in lending. And with today being, May 26, we are in that, we've been kind of steadying still at around the 6% on the rates, right? And buyers are always like, I'm going to wait till the rates come down. Let me wait till the rates come down. And we've been saying that for a couple of years now.
Yeah.
And rates have kind of just been right in that 6 area for a while. And so with buyers needing affordability, there's different programs that lenders are offering. And we're going to talk about some of these programs that you guys offer. But before we get into that, I want you to explain a little bit about yourself, Emily. How long have you been in this industry? What you've been doing with loans, and how long have you been helping buyers buy those beautiful homes?
So I started in mortgages when I was 16 years old. I was the kind of kid that just wanted to be a grown-up. And as my kids say, now I am an adult child. It's kind of funny how that works.
Nothing wrong with that.
But I was going to college in the morning, high school in the afternoon, and then I was doing mortgages in the evenings. And I was setting files up for full-blown loan officers for clients. I was doing a lot of marketing, telemarketing, different things like that. And then when I became 18 years old, they offered me a position to be a full-blown loan officer, which to me was the ultimate. And I've loved it ever since. I was originally going to school to be a therapist. I pretty quickly started to worry that I didn't have the heart for it.
Well, you do have to have some therapy skills when you're in this business. So
I think I'm maxed on my therapist skills just in this because when you care about people, it's really, really hard. And so I think that working with people's finances and their housing is about as intimate as I have capacity for without it completely killing me. So I've been in it it'll be 29 years the end of this year that I've been lending. I still love it, which I think is really special. And there's been so many different times where I've had different opportunities that were really compelling. And I've just thought, I feel like this is a community calling.
Yeah, and I love this industry as well. And so we're going to talk a little bit about some of the programs you offer. There's we're going to start off with what's the fixed rate or what's a fixed loan and an ARM loan, ARM, and what does that mean?
So ARM is an acronym for adjustable rate mortgage. They were really, really popular in like the 90s, somewhat in the 80s. I felt like they kind of made a strong comeback in the early 2000s, and then they went away, and then they came back around the recession, the Great Recession. 2009, coming out of the recession, 2009 till about 2011, they made a comeback. And those were a longer fixed hybrid ARM. So hybrid meaning that they're fixed for the first portion of the loan and then they can later adjust. And that has been something that we had recently seen prior to the United States and the Iran battle and some of the economic shifts that we have endured. Mm-hmm. We were seeing some of these hybrid ARMs in the 4s. Right now they're in the 5s. If things could kind of revert back to where they were in February, which was such a great time, then I think that we could get back to where we could see some hybrid ARM products in the 4s. That was kind of a hack for me the beginning part of this year. I was locking it all the way up until about mid-March, and then the United States and the Iran thing began exactly on March 1st, and it just started to kind of fade out after that. But I am starting to, as of actually today, we are starting to see some hope for that to end and hope to see everything shift back with where we were at interest rates wise.
So it's a up and down thing we have throughout our careers with rates and everything. So fixed, you got a 30-year or 15-year fix. It's one single rate throughout the life of the loan. The 7-year ARMs, the first 7 years, you're going to get them a lower rate than what we have right now as far as what do they call the national average. And then after 7 years, it will go up into whatever the rate is at that time. Is that correct?
Yeah, on conventional, it's most common to have it fixed for 5 or 7 years. And if it's on an FHA loan, it's most common to have it fixed for 3 or 5 years if it is a hybrid ARM.
And then the thinking is if rates adjust in that 3 to 5 to 7 year period, you refi into a lower rate, and then you get the permanent lower rate instead of waiting until the 7 years or whatever it is, and hoping it's a lower rate.
Well, I mean, historically speaking, people usually were staying in homes anywhere from 3 to 5 years, usually in Utah, and then moving just on average. Right now, we're, depending on the data that I read, we're somewhere between like 9 and 12 years because of what has happened with interest rates.
Mm-hmm.
But now that is even starting to mix up a little bit. And I think it is some of these products, the temporary buydowns, the fixed, and versus the hybrid ARM coming out. I think that investors are becoming really aware that there needs to be more options to kind of hack affordability, which is what the hybrid ARM and the temporary buydown create.
And I've told my clients about the 7 year ARMs, and the one question I get the most is, well, after 7 years, what if the rate's too high? I'm stuck now. So I know what I tell my clients, but what would you say to someone that's, if 7 years goes by and I haven't gotten into the new rate, which I don't know why you should be able to by then, but if to answer our buyers' questions, if there's 7 years and the rates just went up, now what? I'm stuck with a higher payment now.
Well, depending on the loan product that they're on and what the parameters are, they typically, when they get to the end of the fixed period, they typically can only adjust 1 or 2%. So if you're already at, say, 1.5% below current market at the time that you closed on your loan, then at the end of the 3, 5, 7, or 10-year period, that in advance, that you're going to be going up 1% to usually max 2% in the initial adjustment. I mean, the other side of it is there are options where, say that the market doesn't shift and you need some kind of relief. You're not able to afford your payment. You could sell. You could talk to your loan servicer about doing a loan modification, saying like, look, I'm not going to be able to afford this ARM. I thought things were going to go one way. Now they're going another. For a long time after the recession, we were doing a ton of HARPs and HAMPs in the industry. Those acronyms are Home Affordable Refinance Programs and Home Affordable Modification Programs. And that's where lenders are enabled to come in and create an environment of affordability and safety for consumers. And coming out of the recession, there's more consumer protection laws to make sure that people can kind of pivot with their loan, if that makes sense, and not get in a position where they feel hopeless.
And that's why I bring you in here, because you actually came up with answers I didn't even know, which is great. And I love that. That's great. My answer was, well, you can always sell your home and you can cash out your equity on it, and because you will build the equity within the 7 year period, but then you've got all these other options as well. So again, if you're unsure about these things, you want to talk to Emily. She has all the answers, 29 years of doing this, and she's seen it all and done it all. So love it, love it, love it. So let's move on to some other programs you guys have. So we got the buy down programs, the temporary buy down programs. That's been really popular the last few years. So I'll let you explain what the temporary buy down, the difference between a temporary buy down and a permanent buy down.
Okay, so a permanent buy down, and a lot of people are somewhat familiar with this. It's where you pay more in closing costs to get a lower interest rate. And caveat to that, one thing that a lot of people don't know is a mortgage loan officer cannot be paid legally based on rate and fees. That's actually been illegal since 2011. It was part of Dodd-Frank. So when people are paying points, I think that some old timers or people that haven't had a mortgage in a long time think that this loan officer is getting rich off their loan, when really the loan officer is trying to get them a better interest rate and create, a tax advantage or just make the loan affordable. So that's a permanent buy down, is where you're paying more in points or closing costs to get a lower rate than what you qualify for. The temporary buy down, the most common is the 2-1 buy down, and that's where the loan is 2% lower than the note rate, so the long-term rate for the first year, and then at the 1 year anniversary, it graduates another percent. So for example, if your note rate, your long-term rate is 6.5 and you're on a 2-1 buy down, the first year your rate would be 4.5. And then at your 1-year anniversary of your loan, it will go up to 5.5 for another year. And then as entering into year 3, then the rate would go up to 6.5 and stay there thereafter. Now, there's also a 1-0 buy down and there's also a 3-2-1 buy down that work similarly. So again, say your rate's 6.5. If you're on a 1-0 buy down, the first year your rate would be 5.5, and then at the 1-year anniversary, it would graduate. And on the 3-2-1 buy down, same theory. If your rate is 6.5, you would start the first year at 3.5. 1-year anniversary, you go to 4.5, another year 5.5, and then 6.5. And the thinking behind it is that you would either refinance or that your financial picture will change and it will become more affordable, because it's proven that more times than not, people's incomes go up, their situations change, and their life becomes more affordable. And so graduating and kind of building up into a higher payment is also feasible for a lot of households. If you do end up refinancing before you finish the period, so say you're on a 3-2-1 buy down and you're only halfway through it and you think, I don't want to waste all of this that I worked for to get this temporary buy down. If you refinance it before it's graduated to the full note rate, then whatever portion of the seller credit that was given at closing to make the temporary buy down work is then credited to the payoff on the next loan. So that money is never lost. It's held actually in a suspense at closing, technically for the life of the temporary buy down.
And you said it's the seller's funds that we're so that's another thing I think we need to also let our buyers know, is that it's something the buyer doesn't pay for this. A seller will pay for this. So you have a good agent like me. We go ask the seller, we would like some extra funds to do the temporary buy down. It's very, very common right now. Everyone's doing it right now. Homes are sitting on the market a lot longer than they used to. So sellers are wanting to get their homes sold. So they're going to try and contribute as much as they can to make that happen. We ask the sellers to contribute some money to this buy down. Like you said, it sits in an escrow account, and they just pull a little bit out every month to make up that difference between the note the rate where it is and then the buy down rate.
Exactly.
And then when it's all said and done, if you refi within a year, whatever's left in that escrow account, you put it back onto the principal, and it's your money. It's always your money.
Yes, it is. It is your money as it is credited to you. It can only be paid. It cannot be paid for by the buyer, so it can only be paid by the lender or the seller. The reason why nobody ever asks the lender is because then, kind of going back to the permanent buy down, if the lender has to pay for it, they have to build it into the cost of the loan. So then the rate goes up, and then you're completely defeating the entire purpose.
So I didn't even know that. I didn't know you could ask the lender.
You can ask the lender, but a lot of lenders, because I've even tried to make it work in certain scenarios where I was paying for part of it, or our company was paying for part of it, and then the seller was paying for part of it. And I've gotten it to work before to some capacity, but like I say, if you're doing a temporary buy down to get 2% lower, but then your long-term note rate is going to be 0.75% higher because we have to build on this credit for you, then it starts to kind of feel like, why am I doing all of this?
It's all washing out in the end. So it doesn't really make sense to go that route.
It takes strategy. Yeah.
So those are that's very, very popular right now, the temporary buy downs. The permanent buy downs are kind of expensive, right? So it's not necessarily a route you want to go with a permanent buy down, but some buyers are more comfortable doing the permanent buy downs.
I think it depends. Different strokes for different folks. Sometimes I'll show people you could take this higher rate and have these lower closing costs, or you could pay all of these closing costs and have this lower rate. The other thing is when you buy down the rate, all of those points are considered prepaid interest. So the tax advantages are there. I typically, if I'm planning on keeping a loan, I typically will buy a rate down somewhat, but I'll calculate it. And I think that that's one of the benefits for somebody to sit down with their loan officer is kind of run the pros and cons of each, because people don't know what their taste is. And a lot of times a loan officer, if they don't get the chance to sit down with the consumer, they'll tend to decide for the consumer.
Mm-hmm. Yeah, so it's always good to sit down with your lender and find out all your alternatives, all your options, and what's going to work best for you. If you got more money out of pocket that you're okay with and you can buy rate down, great. If you don't have as much out of pocket and you want just the lower closing costs, figure it out.
Yeah, exactly.
All right, so let's move on from that. Let's talk about jumbo loans. So currently, you are selling your home, $1.54 million. It's not necessarily a loan that you can just get an FHA loan or conventional. You need to get those jumbo loans. What are jumbo loans and how are those different than the standard FHAs, the VAs, the conventionals?
So jumbo loans are typically, if you're trying to put 20% down, typically if you're buying north of $1 million, because then your loan amount is getting up into the 800,000s or greater. I mean, a jumbo loan, in some cases you can put as low down as 5%. Really, you're going to want to put at least 10% down so that you have the most broad selection of investors with whoever your mortgage company is. If you can put 15 to 20% down, it's just going to get you a better interest rate and even more options. But jumbo loans are more tricky to qualify for in that they are less tolerant for derogatory credit. They are more particular with higher credit scores. They oftentimes have more restrictive requirements for assets. A lot of jumbo investors will want to see that you've got 3, 4, 5 years of mortgage payments in liquid assets or reserves for you to be able to close on the jumbo loan. So there are more restrictions. However, in the same token, there's also non-QM jumbo loans. So if you're going non-mainstream, so non-conventional, essentially, it gets so complicated, but non-QM just meaning that you're going a little bit outside of the box. There are jumbo options there where you can use bank statements for income. You can use your assets to qualify. If you've got 5 years of mortgage payments in your assets, you can literally use that for your qualifying income and just bypass everything else. And shockingly, the interest rate is not that much higher. I mean, in a lot of cases, it's oftentimes only 0.5% to 1% higher interest rate to just use your assets. And you don't even have to provide tax returns or any of that. So there's a lot of cool ways that you can make a jumbo work, even if you have to go non-QM, and it's not super painful.
Yeah, so another option, jumbo loans. If you're looking for those higher end homes, that's another reason to come talk to Emily, and she'll tell you all about those jumbo loans and what other kind of options are available for those beautiful homes out there. Okay, now let's talk about this. This is probably one of the programs I am least familiar with, the bridge loans. So I'm going to let you so you already have been telling us about everything else, but just take it away on these bridge loans. This is another option for, maybe there's a buyer that's in a situation that this would work for them.
Yeah, so there's a lot of different kinds of bridge loans. Bridge being kind of figurative to bridging the gap between being in your home now and wanting to buy another house without having to sell your house. So the most common loan product for a bridge is that they will lend you up to 70 to 80% of the departing resident's difference. So say you owe 50% of what you're selling your house for, then you can take out 20 to 30% of your equity to be able to put it down on the next property. Now, that being said, there are some investors that will even let you pull out those funds, use some of it for your down payment on your next house, and if you have enough left over, you can put some in your reserves or you can do other things with it as long as you're putting 20% down on the next house.
Can you use it to pay off debt?
Yes. You could use it to
get rid of a car payment or a credit card payment or
Absolutely. So there's that, and then there's another bridge investor that actually, this is kind of interesting. They are partnered with a real estate firm that if you don't have your house sold within 12 months, they will buy your house. But they don't buy it at full dollar, which to me is the dun dun dun.
Yeah.
But it's also peace of mind because I think there's some people that really have no tolerance for any kind of chance, where like the hybrid arm is too crazy, the bridge loan is too crazy. All of these things are just too crazy to leave chance out there. And so that one is a program that we actually just barely contracted with the investor for that. And it's an up and coming popular product, but they will essentially, it's my understanding that they essentially will buy your house at 80% loan to value no matter what. And that to me is a hard pill to swallow unless somebody is in a dire circumstance.
Now, when you say 80% loan to value, does that mean they're going to give you 80% of what you have left on your loan?
They'll give them 80% of what the current appraised value or the purchase price, whichever is the lesser.
Got it. Okay.
So that could be a hard pill to swallow. But I think that in some cases, just knowing different scenarios that I've seen, sometimes that's a make sense scenario for somebody. Mm-hmm. They just want to be able to walk away.
So depends on your situation, depends on your financials. This might be the perfect option for you. I heard this is very popular with new construction as well. Is that right? Like you're moving out, so you don't want to pay for the construction costs right away. So
yeah,
or am I off on that?
No, I mean, when you say new construction, I was thinking you meant people moving out of existing homes into new construction. But you're talking about to be able to build a home.
Build a home. Yes. Thank you for building a home, building a custom home.
Building a custom home. I mean, you could, with certain investors, you absolutely could. You would just have to be putting 20% down on the next house cost to build, typically, or the estimated value. It just depends on the investor. There's a lot of different bridge products out there, but I think that the thing that's key is how many people are miserable living in their house with it listed, and they really want to buy and move so they can be done with it. This is the first time in my life that I've ever lived in a house when it was listed, and it is not for the faint of heart. Mm-hmm. We've always bought our next house and then moved and then sold the departing residence. But in this market, it is more challenging. I have looked at doing the bridge loan. I go back and forth because I, too, struggle with the nervous Nelly, if I'm making the right decision. But, I mean, I have seriously considered the bridge loan multiple times. There are good bridge loans.
So depending on your situation, too, you can pivot from one loan to maybe to another, like you're doing right now, like kind of which way do I want to go on this? And you kind of, what's the situation at hand, what's happening right now, and then you can make your decisions, and then you have Emily on your side to tell you all the numbers and what's going to work best for you and what's going to make you feel more comfortable. So bridge loans, that's a good one. And then, I think that's pretty much covered the loans we wanted to, but then, we've talked about renting versus buying. And that's one of my biggest things with my consumers, my clients there. Why should I buy? Why should I buy now? I just rent, it's cheaper, which it can be cheaper, but if you're looking at the big picture, is it necessarily cheaper?
I mean, I always think different strokes for different folks. I try to not make one size fits all, but I will say this. The most compelling reason that I think that most people decide to take the plunge is the exact definition of renting is building an asset or equity for someone else. So you're literally building a real estate portfolio for somebody else when you could be paying comparably, maybe a little bit more, but then you're also going to have tax advantages and all kinds of other benefits with owning and be building your own asset. I mean, I just went through this with a family member, one of my siblings. I was trying to get them to buy, and he didn't want to rent. He wanted to buy, but he didn't feel like he could. And we just kind of went back and forth, and he just said, I refuse to pay rent to build assets for someone else. So, I mean, to me, that is pretty compelling.
Yeah.
And the fact that a lot of first-time home buyers don't know that a lot of the costs that you pay when you close on a house are tax deductible. The interest that you pay on your mortgage is a huge tax advantage. And so, I mean, that's something that somebody would need to talk to a CPA more specifically about. But when you really look at the overall benefits financially, it makes a lot of sense. Not just to mention, there is a very different feeling when you're living in a residence where you have to answer to someone else versus looking at a wall and thinking, maybe I'll put some decorative paneling up. Maybe I'll change the color. Maybe I want to switch out these appliances with my tax refund. You just are so much more empowered. It's a totally different feeling.
I had a quick story. I had a client that was they were renting and they're wanting to buy, but they were still contemplating, should I rent? Should I buy? Should I rent? Should I buy? And so we were talking about it, and they took a long time to figure out that they wanted to buy. But by the time because we got pre-qualified in the beginning, and by the time came when they decided to, let's go ahead and, okay, I think I'm ready to buy, it had been a couple years, and they had priced themselves out of the market because they waited too long. So if they would have bought in the beginning, they would have had, and it was right. And I feel so bad too. It was right after the whole COVID thing, and then when prices just went up, and everybody gained a ton of equity into their homes, and then all of a sudden he priced himself out of this, and he couldn't do it anymore.
I can't even tell you how many people I've seen do this. Where when houses were under $300,000 for like a 3-bed, 2-bath, they were saying, "I'm going to wait for the market to crash," and now all those people are paying $500,000 to $650,000 for the exact same house.
Exact same house, yeah. So that's just, I mean, as far as real estate goes, I mean, over the life of, we've been keeping track of this, I believe there was only 2 years prices kind of went down, but over the long term, it just goes up and up and up. So that means your equity is building. So when is the right time to buy? Right now.
Well, I mean, even thinking about COVID, I think that is the best consumer example that I can give to somebody is look at what happened to interest rates, historically low. Look at what happened to housing. So rates got really low and everybody decided, well, if I'm going to buy, I'm going to do it now. If I'm going to buy or build, I'm going to do it now. And then our market went up insane. I mean, I think that we were experiencing like we're
overpaying for houses.
30% appreciation at one point in some markets of Utah. But the thing is there's so many people waiting right now that are waiting for rates to drop. So when you think about that same logic, well, as soon as rates come down, all of these people that have been waiting, which now they are slowly trickling in because they are starting to kind of realize, oh my gosh, there's so many people waiting.
There's a lot.
Then when rates drop, the houses are going to skyrocket, and then they're going to be back priced out of the market.
And you're going to be going against all this competition. And the one thing I saw a lot of during that COVID years was investors or cash buyers were coming in, and they were putting 30, 40,000 over asking price, 50,000 over asking price, cash.
Yeah.
And my buyers could not compete with that because we were getting loans, and a better offer is a cash offer than a loan offer. So you're not only competing against other buyers, you're competing against cash offers now as well, which is just not in your best interest if you're looking to buy. And I always say too, don't look at the rate. Rates, it's just a number. Look at your affordability. What can you afford? What's your affordability? What's your monthly affordability? And if what your monthly affordability is, and we can find a home that will fit that, we'll find that for you.
And get strategic. Sit down with a loan officer and really run through the numbers, because I like to think that most people will be pleasantly surprised at what they could do.
Yeah, and that happens all the time. I see that all the time too with buyers come in and they go through their loan officer and they're like, surprised, wow, I didn't know I could do this. I had no idea, and I'm so glad I did.
Yes.
I've got a great story about it, and I'll share it another time with one of. Maybe I will share it.
Share it.
Yeah, so I had a client, and Jenna and Michael, if you're watching this, thank you very much. Close friends of mine, like a daughter to me, and they were thinking about buying, and they just got married, and they were unsure if they would be able to qualify. So she asked me, Micah, do you think we can qualify? I was like, let's go talk to a lender. Let's see what your numbers are. Went and talked to the lender, and by surprising both of them, they qualified. And they're like, holy cow, I cannot believe this. And the smile on her face was so huge. Like she was so happy. And we went and, long story short, they came from the worst of the worst slums of Manila, Philippines to now they bought a $500,000 home.
Good for them.
In Utah.
I love it.
And it's because they just went and checked their numbers. They did, again, they thought this is not going to happen. It won't happen. And if it does happen, it won't be anything we're going to like. But nope, they're living the American dream. They truly are.
Well, so much of everything that we're talking about is in people just taking that plunge, because home buying and qualifying is not a matter of if, it's a matter of how and what you need to do to get there. Because sometimes people will say, well, I don't want to buy a house for the amount that I qualify for. And I'll say, well, we could do a rapid rescore. We could get you up here. We could do this. If you could, change your income by this. Because some people actually have higher paying job offers out there, but they're afraid to take the plunge. And there's just so many things to consider. So I cannot preach it enough. Go meet with a lender and find out what's possible. I'm
glad you said that too, because a lot of lenders, and I'm sure you do this as well, is you'll look at someone's credit score, their financial situation. If they're not quite there, you'll give them the tips on what to do. Pay this down, do this, and we'll, shuffle some finances around. And then within 3 months, 4 months, 5 months, 6 months, whatever it is, we can get you to where you need to be.
Well, and if they're not quite where they want to be, like, for example, one thing I've been pushing lately with people is they want to keep the house that they own and buy another house, but they can't quite qualify. So I've been looking at equity share programs for them, and I'm showing them you could tap into your equity. There wouldn't be any payment, but on the departing property, if you want to keep it, you're going to have to share any future equity in your departing residence with this investor, but there's no mortgage payment for them to give you all this money. And then it enables them to go on and buy another house.
So many different programs.
So many
ways. That's one thing about this real estate industry is when a problem comes up, we will find a solution for it. And the lenders are on the front lines of doing this. They're on the front lines of finding solutions for you guys to afford these homes. So thank you, Emily, for joining me today. This was great. And,
so fun.
Yeah, we'll have to do it again.
Yes.
And then if you guys have any questions about anything or anything we didn't cover or things we did cover, I'm going to leave Emily's information in the description below. My information will be down there as well, so scroll down and check it out. If you're watching this on YouTube, please subscribe to my channel, comment. If you have any questions, let us know. If you're on Facebook, give me a like, follow, and then thank you again. Thank you, Emily.
Thank you.
Bye.